What is cost averaging? Cost averaging is a simple way to invest your money over time. Instead of putting all your money into an investment at once, you spread it out and invest a fixed amount regularly, say every month. This means you buy more when prices are low and less when prices are high, which helps smooth out the ups and downs of the market. Many investing platforms let you set this up automatically like a direct debit, so it's easy to build the habit without even thinking about it. Why does it matter? Investing can feel risky, especially if prices go up and down a lot. Cost averaging helps take the stress out of trying to time the market, that is, guessing the best moment to invest. It brings structure and calm to your investing. It also helps avoid the emotional highs and lows that come with seeing big gains or sudden losses. And for people who get paid monthly, it's a natural fit. You just set up a regular payment and let it run quietly in the background. It's not just for beginners either. Even experienced investors use this strategy when markets are unpredictable or volatile. Here's a simple example. You decide to invest £100 a month into a fund. In month 1, the price of the fund is £10 per share, so you buy 10 shares. In month 2, the price drops to £5. Now your £100 buys 20 shares. In month 3, the price goes up to £20. Your £100 buys 5 shares. After 3 months, you've spent £300 and bought 35 shares. The average price you pay per share is about £8.57. Even though the price went as high as £20 and as low as £5, that's the power of cost averaging. It helps you take advantage of both the lows and the highs without needing to predict them. What else should you know? Cost averaging isn't magic. It doesn't guarantee profits, and if prices only go up, you might end up paying more over time than if you'd invested a lump sum at the start. While lump sum investing can lead to bigger gains if markets rise steadily, cost averaging spreads out the risk and is emotionally easier for many people. It also works best when you're investing regularly over the long term. If you're only investing for a short period, the benefits may be smaller. And finally, make sure you're still investing in something worthwhile. Cost averaging can't fix a bad investment, it only spreads out how and when you buy it. To sum it all up, cost averaging means investing little by little rather than all at once. It's a steady, calm way to deal with the ups and downs of the market, and a great strategy for building wealth over time without the drama. Whether you're a beginner or a seasoned investor, it's a tool worth knowing. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.